For more, we're joined by Thomas Hayes, who's chairman and managing member at Great Hill Capital. Thomas, thanks for your time this morning. So just taking a look at Wall Street, really taking a hit overnight, and that was largely driven by weakness in AI-related names. I mean, how would you characterize, I suppose, investors' sentiment at this point?
Well, I think you want to be fearful when others are greedy, and there was a lot of froth and a lot of greed coming into this morning. But I do think the catalyst was Palantir. Yes, they beat on the top and bottom line. Their guidance for next year was a bit hazy. And then we saw the 13F filing from Michael Burry, who's famous from The Big Short, taking out puts on 5 million shares of Palantir and 1 million shares of NVIDIA. So what's been on people's minds, they saw other actors in the market starting to take action on, and people started to think about, yesterday before Palantir reported, there was a report out estimating, projecting that Palantir should be $1 trillion company. Well, they did $1 billion in revenue last quarter. So 4 times that is 4 billion. That's 250 times sales is what that report was projecting. They're trading at 250 times forward earnings. So it's not to say Palantir is a great company. They're doing great things. They're going to continue to do great things. The question is, price is what you pay, value is what you get. And I think investors are starting to take inventory when you see the amount of CapEx that these hyperscalers are spending, which is now approaching 60% of operating cash flow going into CapEx. The only other industry that high is big oil.
Well, Thomas, I'm also wondering if the comments by executives from Goldman Sachs and Morgan Stanley are also contributing to the market jitters, because they've been warning about the potential for a 10 to 20% market drawdown in equity markets. I mean, are they ripe for a correction, you think? And what does this mean for the bull market, which has been pretty resilient so far, especially since April? I think the S&P 500's forward PE ratio is now above 23, which would mean that is the highest since 2000. So really, how concerning is all of this for you?
Yeah, we're ripe for a pullback. We are not ripe for a correction. On years where you have a correction of 15% or more, and then you reach all-time highs, the secondary pullback usually averages over the last 40 or so years 6.4%, between 3% and 9%. So I think we're more than due for that. But you got to look at the backdrop. Global liquidity is at a multi-year high, over 313 central bank cuts around the world, the highest since 2010. So there's a lot of liquidity. Earnings have been good. Earnings are going to be up 13% next year. So yes, should we pull back 6 to 9%? You bet. Investor sentiment got frothy. Retail investors were all in. The longest call buying streak, 25 weeks of call buying by retail investors. There was a little froth. That has to get knocked out in the next few weeks. But I think it's more 6 to 9%. I think 10 to 20% is a little bit too much. And that's a little bit of recency bias based on what happened in April, and unlikely to happen given Atlanta GDP now. To your point, you were saying the shutdown could take 1 to 2% off of GDP. It's currently tracking at 3.9% for this quarter. So we can afford 1%. And I think the market's a little jittery, but a healthy pullback would be a good thing, not a bad thing.
Yeah. And so, okay, the pullback is 6 to 9%, or maybe, the 10 to 20, which seems unlikely in your assessment. How should investors approach it then? Do you see it as a buying opportunity, or maybe, a sign to de-risk portfolios?
I think you want to stick to value. As a matter of fact, value has outperformed growth in Q3. I know a lot of people are just focused on the hyperscalers, but the outperformance was largely in August, 700 basis points of outperformance. If you buy great businesses, yes, the AI pocket is a little bit frothy with the hyperscalers, margins coming down and the CapEx going up. But basically, outside those 7 to 10 stocks, you could throw a dart at a board and find a reasonably valued stock. So there's a lot of great companies to buy. I think if you stick with higher quality, one of our biggest holdings is Alibaba, which is an inexpensive way to play the AI revolution, trading at mid-teen multiples versus 30 plus times in the US, with a lot more upside to be had. We've had that one for a while. Intel is going to have to provide the chips. Everyone's chasing NVIDIA. They should be chasing Intel because NVIDIA's success depends on increased capacity beyond Taiwan Semiconductor that'll be coming from Intel. And then some of the oil and gas plays that are going to power this future, like Comstock Resources we own, is a natural gas play in the Haynesville Shale, and Generac, which is doing all the backup generators for the data centers. So there's some covert, inexpensive ways to play this revolution, which is real, but some of these companies are just too overvalued and require too much capex, and those are the ones that are getting hit.
All right, Thomas, appreciate your time today. Thomas Hayes, Chairman and Managing Member at Great Hill Capital.